Good morning, traders and investors. Roger Scott here, senior strategist for Wealth Press. Today is Wednesday. It's May 31st. I keep thinking it's Tuesday because it's the second trading day of the week, but we had a short week. Now, remember what I always tell you. Typically, usually, not always, but 90% of the time, whenever you have a fragmented week, whenever you have a short week, what happens is market participants take advantage of the holidays, especially large hedge fund managers that have the luxury of having tons of employees, like the guy who sends his staff to Disneyland, Ken Griffith, for example. Don't even get me started there. But the point is, it usually takes the market a few days to get going, so don't expect a lot of volume and volatility to really come in till maybe the end of today, tomorrow. That's when the week really starts. So that's why yesterday options were a little wide, liquidity was a little wonky. Takes a few days after a major holiday, especially like Labor Day or Memorial Day, first holiday of the summer. People are still coming back. Like my assistant Matt, he's coming in today for the first time. He missed yesterday because he was on a holiday. People are traveling, unforeseeability, so forth and so forth. The point is that you got to give the market a day or two to get going after a major holiday because most of the trading action leading to that is random. Now, the market is down today. Nasdaq is down 51 points. The Dow's down 74 points. The Nasdaq's actually weaker than the Dow because you could see here the value of the Nasdaq 100 is about half of the Dow. And I explained yesterday that it looks like a lot of these sectors are topping out. For example, look at the Nasdaq QQQ right now. It looks parabolic, right? Look at SMH. It looks parabolic. These type of moves. Now, here's what you need to understand. If all of a sudden this starts moving sideways and doesn't relieve this pressure and it doesn't go right back down over a few days, then there's a good chance this pattern will continue. So in other words, if it starts creating a flag and consolidating, that means that the price can hold up these levels. But if the price starts coming down within a week, that means this is over, and then it could really, really be over. And notice QQQ, same type of price action as semiconductors. This rally has been very, very narrow. As a matter of fact, if you look at the equal weighted Nasdaq, you could see it was actually down yesterday a little bit. It didn't close positive. It opened high, and then it went down as the day continued. And you could see right here, this thing is pretty much over, and it looks like we're going to be coming back into this range. This is a pure algo ploy right here. This is a pure algo move right here. So you could see yesterday was kind of like, hey, let's see what else we can do before taking it down. And they have the ability to do that because volume and liquidity is low. As I mentioned over the last few days, I think the bond market is going to continue moving higher because I think that there's further relief that this debt ceiling pressure is going to be relieved over the next few days, which will drive interest rates, long-term rates lower, and the sentiment to lower rates in the short term, which should cause the bond market to rally. So expect to see more of that in the coming days. Now let's talk about news and what stocks are coming out with earnings today so we could watch something, and I'll talk about them more in the VIP room and give you some potential setups. So market participants digested weak Chinese manufacturing data while nervously awaiting the final vote on the U.S. debt ceiling. Now, it's going to happen, folks. Don't fret out. It's going to happen. They always get into this, and it always happens. We're not going to have 2011 all over again. Obama's not driving the White House anymore. The debt ceiling deal struck by President Biden and McCarthy is headed towards vote later today after clearing a key procedural hurdle. Congressmen have until Monday next week to approve a deal between Republicans and Democrats to temporarily suspend the U.S. debt ceiling and cap federal spending to prevent a U.S. default. Tech-heavy Nasdaq outperformed benchmarks. Don't hold your breath. It's not going to continue much longer, and helped in part by about a 3% rise in NVIDIA. That stock just can't stop. But remember, the market is not being driven by Apple and NVIDIA. Paramount, I love their shows. I love King of Mayortown. I'm just watching it last night. Surged over 6% after Wolf Research upgraded the stock to peer performance from underperformed, helped the benchmark close essentially flat. Energy stocks were the biggest drag on the market as the price of crude oil plunged over 4% to a two-week low on worries about U.S. debt ceilings and OPEC infighting. I think it's more of a slowdown in China why crude oil is going down. And we'll talk about that in a minute. But if China slows down, it's a big red flag for crude oil because there's a lot of industrial production going on in China. Economists on Tuesday came out with the consumer confidence, which is actually better than expected. Could have caused the market a little more upside yesterday in a broad rally, which we didn't see, but too busy. Everybody's too busy with chip and three tech stocks. Now, Richmond Fed President Barkin said Tuesday, interest rates have entered restrictive territory. At the same time, he hasn't backed off from his rate forecast, which he said is amongst the highest ones within central banks. Now there's almost a 70% chance that we're going to have a 0.25 basis point rate hike, and only a 31 that there's not going to be a rate hike. Now, I remember somebody by the name of Roger Scott telling you guys this and warning you about that and saying how foolish it is. Stocks to watch today: CRM, CrowdStrike, NTAP, Okta, and Chewy. They're going to be reporting today. We got to watch these stocks. I don't know if they're reporting before the open or after the close, but those are the stocks that are on the table that we got to watch carefully. And CRM has big market caps, CrowdStrike. It'll be interesting to see how these tech stocks do, and it'll be interesting to see how Chewy does. Implied volatility on Chewy, by the way, is very high, so expect some volume there. We're looking at the job openings report. That's coming out at 8:30, I believe, and we'll see how interesting that becomes. Additionally, we've got Bowman, Jefferson, Collins, Harker. They're all going to be talking. But again, what did I tell you? Remember when this was at 30%? Remember when this was like at 12%? And this was like at 90%? And I said, this doesn't look right. This does not look right. And here we are. Europe is down 0.42 as investors waited disappointed economic data from China while remaining cautiously ahead of a vote to raise the U.S. debt ceiling. China is not doing that well right now, as we'll learn in a few minutes. But that's Europe, not China. They're looking at the U.S. debt ceiling, and they're looking at China. Now, China closed lower after disappointing factory data, and this can really drive U.S. stocks lower too, especially stocks that are related to this, stoked by worries about the country's slow post-pandemic recovery. The Bureau of Statistics, which I don't really believe, said Wednesday that China's factory activity fell to a 5-month low in May. That's bad. I think it's worse, though. Contracting even faster than expected. Also, service sector activity expanded at the slowest pace in 4 months. So there's a lot of stuff going on with China. Nikkei. The index closed lower, snapping a 4-day winning streak as investors locked in profits, while the stronger yen also weighed on export-oriented stock. Data on Wednesday showed the country's industrial production unexpectedly contracted, while retail sales grew less than expected. So, whole world economy, China, Japan, they're not doing as great as a lot of people have thought they were going to do beginning of the year. And again, we've got earnings coming out from major companies today, and I'll talk about that plenty in the VIP room today, which is at noon. So you've got NTAP, Okta, Chewy, CRM, CrowdStrike, and I'll talk about all four of them today as we get into the room. But the big takeaway here is, just so you know, 68%. We went from literally like 12, 15%, something like that, to 68.2%. And I bet you this is going to go higher to over 70% because it's very hard for the market to not raise rates right now. We're in an inflationary environment, and that's just how it is. I'm expecting the bond market to continue moving higher as we get more relief from this debt ceiling over the next few days. The Nasdaq, as I said, be really, really cautious right now. Notice how Nasdaq went up? Well, look at what went down. Utilities and consumer staples. All the market cap that was in these stocks went from defensive stocks to speculative stocks. Now, why speculative stocks right now? It makes absolutely no sense beyond the fact that earnings on a couple of them are good, and there was a relief that there was not going to be an interest rate hike. Well, that's over, and if anybody thinks that the defensive market action is behind us, I got a bridge to sell them. You know what I'm saying? So be really, really careful right now. Now, I know we missed the bull run in technology, but hear me out. That bull run was literally caused by 6 stocks. So you got to be really cautious. Now, I've got some good players for you today, and I think these stocks are going to make good breakouts. Why? Look at Lilly right now. We rallied really hard. For, from March all the way to May, and then we've been consolidating. That drop hasn't occurred. The longer it can consolidate without a drop, the better the odds are the price is going to do another leg up or continue consolidating versus going down. And we can live with that. DRI, same thing. Notice this rally and notice the consolidation. The fact that, and this is not a chip stock, these are defensive stocks. So the fact that they had positive news, this must have been earnings or something, And same here. This must have been during earnings. But look at how they've held up. They've held up really, really well. The fact that they've held up well is very positive. So I'm liking these stocks quite a bit. Darden, DRI, and Lilly. Now, for the downside, Match.com, I think Match has overstayed its welcome. And also, there's a little bit of a chip or consumer discretionary in this stock, and those have been rallying really hard. And I think those stocks are done. Momentum levels can't even keep up with this. Look, momentum level here is so much lower than here, and price is up here by 60 cents. So I think we're almost overdone with Match.com. Definitely a stock that I will be shorting. And another one is Catalent. Matter of fact, we were short this stock, and yesterday I heard that they were delaying their earnings till yesterday, but I don't even know if their earnings came out. Something is wonky with the stock. They keep delaying earnings, which is very bad for a stock. But we got out of it with a small profit, but I would love to get back into it. I don't even know if earnings came out or not, but I want to get back into the stock because I think it's going to come down. So two of the stocks that I'm disliking right now are CTLT and Match.com. As you could see, they don't look all that different. We have a sharp down slope and some consolidation. Sharp down slope and some consolidation. And in my opinion, this thing is really, it's been a sympathy play because of the tech and consumer discretionary. Look at consumer discretionary lately. And this is definitely a consumer discretionary stocks. They've been just going up like crazy, but there's really no reason for consumer discretionary, especially if there's a slowdown in the economy, to go higher. And communication has been going up. Look at this. See that? And obviously technology. Look at that. And momentum levels in technology right now, you got to see this. Let's see. Infotech. Look at this. Jeez Louise. Look at that. So I just don't think there's that much more upside. Momentum levels here couldn't keep up with that. So even momentum levels could not keep up. The equal weighted momentum levels couldn't keep up with it. So I think tech is overdone, and I think you're going to see some market capitalization move into the defensive players. Folks, before I let you go, I've got a treat for you. Yes, a treat. Celeste, she's a treat for everybody. Trading veteran Celeste Lindman, she's going live at 1 p.m. Eastern Time for a special presentation. She's going to reveal the one market that's safe and more reliable than stocks. It's not gold or real estate, and it's much larger and older than the stock market. She calls them Liberty trades. And with this new strategy, it doesn't matter which direction the major indices are moving. It doesn't matter which direction the indices are moving. Celeste hit the nail on the head with her May prediction. And you don't want to miss what she's predicting in June. Click the link below. Save your seat for her free presentation. You guys are going to love it. Follow the link. It's in the YouTube Wealth Press channel. You just go to YouTube, go to Wealth Press, and while you're there, comments, feedback, questions, I will respond to all of them. Have a wonderful Wednesday. I almost said Tuesday, but have a wonderful Wednesday, and I'll see you soon. And remember something. We're watching CRM, CrowdStrike, NTAP, Okta, and Chewy today because there's earnings, and I'll update you in the VIP room on what to expect. Follow the link. Don't miss out Celeste. She's red hot, and she's a pleasure to work with. Bye.